Welcome to this monetary policy special. The Monetary Policy Committee of the Reserve Bank voted unanimously for a rate cut on April 9th and an accommodative stance. And the minutes of the policy, which are just out, indicate a strong dovish tone in the writings of practically all the members. Governor Sanjay Malhotra has summed up the arguments beautifully in his minutes by saying that with CPI inflation aligned to the MPC's target of 4% and growth moderating, it was logical for the MPC to cut rates and change the stance to accommodative. Strongly agreeing with him were the other members, including Mr. Nagesh Kumar, who has actually very strongly pointed to the hurdles to growth emanating from the global sphere thanks to the US tariffs. Joining me now to comment on the minutes and the state of the global economy and the Indian economy is Mr. Nagesh Kumar himself, external member of the MPC. In a bit, I will also be joined by Abhishek Upadhyay of ICICI Securities PD and Suvodeep Rakshit of Kotak Institutional Equities to give us the market impact and market reading of the minutes of the MPC. But first, let me welcome Mr. Nagesh Kumar to the conversation. Thank you very much, Mr. Kumar, for joining me. First, if you can parse the global environment, sir, the way you have written, it looks like a recessionary conditions are imminent. Can you tell us how bad this impact can be on Indian growth? Should we be prepared for something less than 6.5?
I mentioned in my statement that there are 2 or 3 things one should worry about, because the meeting happened during 7th to 9th, yes. And that was just exactly 1 week after the 2nd April Liberation Day announcement of President Trump, where he slapped very high tariffs on every country. Now, some of our Indian economists and analysts are reading something positive in it because India was, sort of slapped with 26% tariffs vis-a-vis other countries, our peers, a much higher, percentage. So we were taking a bit of relief that we may be spared lightly, and we may actually be able to make more inroads in the United States market because our peers are facing higher tariffs. Now, but that is only part of the story. The second part of the story is that China, which is facing 145% or 245% kind of tariffs, and that means they will be really eased out of United States market, and the kind of excess capacity they are sitting with and the deep pockets, they will begin to dump that capacity in Indian market and in our other destinations of exports, EU, UK, and rest of the world. So we may be getting a hit in our exports and in our domestic market, domestic production as well. And the third thing I pointed out was that there is a serious risk of a world economy getting into a kind of a prolonged recession, which may impact Indian economy also like any other. So there is a compounded kind of thing, but that is all evolving situation. One has to see how the negotiations that different countries are having with the United States are able to bring them down, these tariffs. And then what else is done to support the growth and not allow it to go into recession globally. So all of these are open questions which we will find answers to in the next half a year, 5-6 months, are going to be very critical. As of now, I mean, there is some decline in the projections, like RBI projection for India for 2025 and 26 was 6.5% growth rate, but IMF has come down and has brought it down to 6.2 for 2025 and 6.3 for 2026 for India. So there is already some kind of a downward pressure on the growth rates projected for India. But one has to see how the situation evolves.
Okay, okay. No, Mr. Kumar, you're very strongly pointing out to instances of Chinese dumping in other countries. So do you foresee a very good possibility that inflation in our country may be actually even less than the 4% that Reserve Bank has now forecast for this year?
I think inflation-wise, we are now seeing not so much of an issue. First of all, the crude prices have come down below $75 to a
Yes.
barrel. And all other commodities are also heading downwards because Chinese economy will be slowing down. And that is a major source of consumption of these commodities. So that is one factor. Then the projections of our monsoon, our predictions of our monsoon are going to be that it is going to be the normal one, and that helps in keeping prices in India in check. So I think from every sort of region or direction, you could feel very much convinced that inflation will remain range bound, so to say. And different surveys are also projecting the sort of inflationary expectations remaining anchored.
But, the normal way in which we are made to think about monetary policy is that it should be inflation plus 1.5%, the real rate. So most people were arguing for 4% CPI forecast, add 1.5%, which is seen as the real rate, and 5.5% would be the, the end rate of this rate cutting cycle. Do you think it can be even more, like, 5/4 of 5, considering that there are serious disinflationary pressures coming from the global environment?
This is something which one has to take a call, and the frequency of MPC meetings is, I think, very sensible. Every other month we meet, and so we will take a call when the more up-to-date numbers are available. And it's hard to say at this stage, but all of us in MPC were very much concerned about what is happening in the world economy and how it would impact India. And if necessary, we sort of take action accordingly. So right now, it would be very hard for anyone to say that it will go down to which level. But I think everyone is concerned and is watching and very cautiously. And there would be, I'm sure, no effort will be spared from either RBI or the government of India to sustain and protect or preserve growth rate.
Okay, but what is your own reading? I mean, your arguments are sounding very concerned about the global ambience in terms of a possible recession and possible Chinese dumping. So if you have to choose, do you think you are likely to see lower than forecast growth, as you say, 6.2 that the IMF has put out? What's your own reading? Do you think growth can be much lower than 6.5 and even inflation lower than 4?
At this stage, it is not wise to hazard because the actions can be taken to prevent that from happening. Okay. So it is possible that we are able to have a very good deal with the United States, which is very much possible. And it is also possible that other countries can also arrive at some kind of deal with the United States to prevent this global recession from happening in a very serious manner. So all of this is kind of something we need to watch, but not be concerned overly at this stage. So I think that's why I said next few months are going to be very sort of challenging in the sense that we need to be watchful and take action.
All right.
So, yeah.
I get your point, sir. You don't want to jump into any conclusion at this juncture. But I have to jump into a commercial break. Coming back in a jiffy, and we have more questions for you. And I will be inviting my other guests, Suvodeep and Abhishek as well, back in a jiffy.